Hello ladies and gentlemen, and welcome back to a special weekend edition of the markets around the world. Well, so far so good for our golden pocket idea and strategy. Of course, the market has moved in the bullish location that we wished it to, and so far it has been a pretty good trade. But we enter into one of the biggest weeks of the year, the middle of September, the quadruple witching options expiration, and some of the largest option shorts that we've seen in some time. So will the market look like this, or is it about to slingshot to all-time highs? We've got a lot to discuss in today's video because realistically, this is crunch time for the markets. The worst month of the year is here, but so far it's not acting that way. Stay tuned as we cover it all off right now. See you soon. Well, welcome back everybody to the special weekend edition of the markets around the world. If you like stocks, commodities, or cryptos, consider subscribing and of course smash that like button if you find value in today's video. Let's begin by discussing smart money versus dumb money. Institutions are paying record amounts for put protection. So a lot of people think, well, that means that I should be buying put protection on the next week. Yeah, timing is everything, unfortunately, in these markets. And as we see here, institutional traders' average premium call minus put premium has entered a new low. This is an extreme level. If we think about previous times that this has occurred, there has usually been more to come. It's just taken a little while to get there. The squeeze, the traps, the plays that the market likes to put in certainly do tend to happen. Last week's panic hedging was so big that it was actually 3 times more than the extreme that we saw in 2008. So does this mean that more selling is on the horizon? Well, let's just talk about all of the facts and figures. We'll start with the macro information here, then we'll lead into the lead indicators because, of course, we've got yields starting to get out of control again. And then we'll go through, of course, the key levels that we need to be looking at on the markets right now. Let's talk about the first sign of oversold conditions. Now, this is something that helped us to try and figure out that we were going for a bullish move over the last week. And that, of course, did happen. The composite washout model signal count gave us an idea that it was a little bit of an oversold condition. And of course, the sentiment was there as well. Dumb money went super bearish. Smart money was buying this current dip. Now, that doesn't mean that the smart money always makes money. Of course, they don't. If you think about some of the other periods when we were selling off in 2022, they were buying the whole way down. And probably some of them were reduced, some of them exited. We don't exactly know where they're at. But one thing's for certain is that dumb money just became a little bit more bullish on this market. This signal has actually switched to the upside. And this happened with previous drops or just before drops. Remember, it has to trap more liquidity and more orders into this market. How do we know dumb money is so exceptionally short in this kind of market condition? Well, really it comes back to surveys. Look at this. Only 18.1% of retail traders out there were basically bullish over the last week. 28.7% were neutral and 53.3% were bearish on the next 6 months outlook. That allows it to be a squeezing type of position. That is a market that really moves towards the upside. Too many people are bearish. It's time to, of course, switch that story so that you believe it's now bullish. And it's going to be very, very tough to navigate really all of the rest of 2022 and 2023 due to the recession-like parameters that we have in the US market and, in fact, the markets around the world. And we'll be following all of those, so make sure to subscribe if you're interested in more content like this. A significant contraction in prices paid. So this is the ISM prices paid index 5-month net change. Now, this is actually showing some bullish and kind of good signals. Negative 34.6. Things are starting to relax, and it's one of the signs that maybe we're seeing a little bit of that kind of demand or at least construction towards measure of inflation collapsing. Now, the good signal here is that if we take it over a 1-year period, it offers us a pretty good statistic. 100% of the time, the market was actually bullish over that next 12 months. Here are the readings all the way back to the 1950s. But what's more interesting is look at that next 1 month and possibly into 3 months. The kangaroo style market we've been talking about, up, down, and all around. And these are the types of indicators that we really want to be paying attention to. Another one is when we get this reading, what happens to commodities? Well, often commodities actually drop over that next kind of 1 to 6 month period. In fact, if you look at that next 2 months and 3 month period, commodities have some seriously bad positive signs with them. And this is in line again with our concepts on oil, demand dropping for that. And of course, it's getting hit right now quite heavily. And our general weaker sentiment across most of the commodities realistically over the next kind of 3 to 6 months. But how do we know whether we've hit the low in the markets? Well, this is our best lead indicator. Of course, we talked about yields before, the bonds market. For anyone that's not familiar with it, the easiest way to look at it is yield inversion. If we ever see over 50% of all of the yields inverting, that is the 2-year versus the 10-year yield, the 3-month versus the 10-year yield, all of these, we generally are seeing a US recession. In fact, it's never really been wrong at calling a US recession, and it often does call it early. Now, of course, we don't even know what US recession means anymore, but it does help us to kind of construct some concepts that we've seen before, and of course, look back at historical kind of bear market pushbacks and things like that. So we've got here some correlations. Many of the long-time viewers will be sick of this chart, but I want to bring it up again because it's very key that we keep an open mind to this concept. Markets in 1962 dropped near to their lows again before recovering. Markets in 2015 dropped to a slightly lower low before recovering. And of course, the other correlated markets, 2008 and 1973, not only dropped to new lows, but of course, continued on. So which one are we in? We don't know. But in all cases, if there was a US recession or at least a multiple pullback kind of period, we tended to see in these correlation periods a nice pullback healthily to those lows. We also know that we're in September, the worst month of the year. But if you look at September, the start of September is not where the problem starts to lie. It's usually after that big options expiration, right in the middle of the month. This is 1931 all the way through to present day. And you can see the weakness that often comes through that middle of the month. Will it happen a little bit later, similar to other years, or will it be like any other midterm election year and drop off leading into this absolutely massive options expiration? Well, that's something a lot of people are going to be paying attention to. For the bulls out there, which of course, it always pays to be an optimist in markets over the long term, then you can be looking at things like the 200-day moving average. Can we get above it? It's a pretty good indicator if you look at back in history at being able to predict that there's a good chance that the market has ended its bear bust. We haven't seen that yet in 2022. We got really close, but of course, that's where we started this really big bearish kind of tinge to the market moving down. And so far, so good on that overall strategy. Let's move over to the charts now and talk about the VIX. Well, guys, the VIX here, the volatility index, 22.78. It's almost all the way back down to 20. So we know a lot of people have been buying VIX calls. The market probably doesn't want to pay them out. So maybe come options expiration, there might be a whole bunch of VIX calls expiring, and then we move into that higher volatility kind of period of time. We'll need to watch the VIX, but we're not at any extreme. We're not at 35, nor are we at 20. We're kind of just pulling back and expect the VIX to, of course, spike up if you expect the stock markets to fall down. Now, what's the worrying signals here in the markets? Well, take a look at this. This is the US 2-year yield. Now, we've seen this one before in 2022, a new high for yields, 3.565%. So that's a new high on the 2-year yield. Actually, I'll give you this right now. Let's have a look here at interest rates. In the future, if we're talking into next year, the interest rates have now got a 4 handle on them. If we go to April 2023, take a look at this. 4% plus expected for the federal funds rate. And if you think about how this is correlated to the stock market, you can actually do a correlation. Usually this yield has front loaded a fall on the markets. That is, if the yield keeps going up and the stock market's going with it, that is not a good sign, and you need to be very careful and always practice that risk management in these market conditions. The US dollar has also fallen off. So far, so good, I guess, on that trade if you're in it. However, it's at kind of like a key pivotal point. I think it's way too early to call the weakness in the dollar. The markets down here, you'll notice, is really where things really change for the US dollar. And over the next week, key levels to look at will be a closure underneath 108, probably a movement down underneath there, and then the potential here to get back into that kind of 105 area for the DXY. It's going to be tough, though, for the US dollar to really weaken because this is a tale of two stories. It's central bank versus central bank. For anyone that's not been following Japan for a while, you may not be aware that Japan is trying to cause deflation or keep deflation in an inflationary environment. And this is causing some serious problems. And this is a story that dates back all the way into May and April of this year. The Japanese kind of central bank is trying to keep these 10-year yields at 2.5, so 0.25%. What we might see is a reoccurrence of this. If you look at the US dollar versus the yen, really it's starting to get put under pressure. We're back at 0.246. Have this chart on there. It's JP10Y on your charts, because once that starts spiking, this could cause a serious, dramatic kind of shift in the markets. How will it end up acting? I don't know. Of course, the USD yen is going to be one to follow as well. And if you bring that up on your charts, you'll notice over here, we've got a pretty serious movement for the US dollar yen. That is, it's pretty bullish over the last couple of months, all the way up here, weakening of the yen, strengthening of the US dollar. And this is a huge reason why that DXY is so strong. Because if you actually load up things like the euro versus the US dollar, you'll notice that it looks completely different on a chart. If you go down to a daily here, you can see that it's kind of consolidating and looks a lot stronger overall than it should, considering where the US dollar is. So there's a disconnection here in the currency worlds. Be careful, and you're going to have to treat each one separately when it comes to trades. We certainly have not seen significant weakness in the US dollar just yet. And that's a kind of good sign as well if you're a bear in the markets. The US dollar could continue to power up. And if it does, of course, we could be seeing more downside as money, or smart money, could be running into the stock markets. Let's move over to gold. What's going on in gold? Well, we have more bounces off our key zones. And gold does look relatively strong right now. Long leg doji has been formed here at the 1717 with the close. We saw that huge level that we've discussed so many times bouncing the zone. And if we now go down to something like the 2 hour, you'll notice for the week ahead, we've got some key levels. Realistically above 1742 and this zone here. Very pivotal and starts to look pretty good. Basically, we got through this area, but we've made a series of higher lows coming into it. So we'd like to see a significant break above that 1730 zone again. And at this stage, it does look like people are trying to buy gold and get back into it. The hedgies, the big ones, they're trying to do some money flow into gold, but time will tell whether it holds up. 1717, it's in line with our current predictions and current concepts. Big key levels to watch, that 1740 zone, and realistically 1760. That's going to be a very big one, 1760. US oil, tough to read at this stage. Closure, long leg doji again, equilibrium in the market, a high, a low, an open and a close at the same level, previous resistance, and just sitting on the support. It's pretty tough, I think, on oil, and there's a lot of geopolitical tensions here. Long-term prospects, that is the next multi-months, is still to the downside. You saw that kind of reading before when we talked about the ISM. If that comes true, we could realistically see even as low as like a 65 on oil. And it's getting into our targets at this point that we've discussed now for many months on this channel. So follow along if you want oil, but I'm not too sure if it's the best thing for the week ahead. Let's move over to Tesla. What's going on there? Well, Tesla's just absolutely blitzing it. Of course, when the market gets bullish on sentiment, we've got the hammer down here, 3 days of incredible bullish action. It was actually better than the Nasdaq in terms of overall returns over that period. And that's how I'm treating Tesla at the moment. Look to the major indices that we'll be covering in just a second. We're looking at things like Nasdaq, SP500, Russell 2000, those types of things. If you think they're going bullish, then of course a conduit for that could be something like an Nvidia or a Tesla or an Apple, any of those ones. But Tesla ramped up pretty nicely. We've got some resistance zones coming up soon at around this level here, which will be between that kind of 305 and 308 area. That's going to be a tough range to get through, and it's going to coincide very well with the SP 500 hitting some key resistances we'll talk about soon. Do keep in mind, still some big gaps left over from previous market conditions on things like Tesla. So it's very easy for the market to do something like this in the future. And I think you want to be always patient and don't have FOMO in this market. There will always be another opportunity. Just remember that. XLY, XLP, this often we use to figure out whether the market is risk on or risk off. Pretty strong week, you've got to say. Very strong action. The consumer discretionary side was doing very well in comparison to the staples. So we didn't really see a strong movement into defensives like you would expect. Consumer discretionary is coming back. Some things are improving in the economy. although there's so much still to hate. But there are some things that possibly on the surface look like they're improving. Let's move over to the Nasdaq. Still room to go up? Absolutely. Look at this. The market is here. I don't like the risk rewards anymore. For you people that got in on these levels down here, congratulations. You've done really well. Well done to you. However, at this point, you've got to start getting a little bit more cautious. Zones like this one up here, 12,865. This is going to be a pretty significant level. We've got a lot of dojis around this point. We've got a lot of previous resistances and supports. We have a huge amount of potential role reversal in here. And realistically, by the time the market gets back to here, people will be going very bullish in their sentiment. You could have things like trend lines, all sorts of things drawn over this area. So it's going to be a big one to watch. And it's hit what we would call the first target. That 12,600 was a fantastic zone. And of course, I think a few people would probably profit taking on that into the weekend. Pretty strong stuff on the Nasdaq. But now we move over to the SP 500. Of course, the golden pocket worked out perfectly. There was the golden pocket. It hit that zone, previous resistances, supports, all of the good stuff that was there, and the rally has ensued. Now, in some ways, people call this a double bottom. So if they call it a double bottom, which is totally fair to do, you can then take that distance and extrapolate that out to try to figure out where you think the market's going to. And what you'll notice is it comes up with around that 41.30 zone. And this is where things get really interesting because we can stack that zone quite a lot. If you notice on this chart, you've got that previous kind of resistance that goes through there. You've got the previous supports that go through there. You've got a whole bunch of market structure that goes through this entire point. And this is where the bears and the bulls are most likely going to fight it out. Now, could they go earlier? Of course, but it seems likely that coming into options expiration week, the big one, this is going to be an interesting zone. Another reason we can find this area so good or so, positive in terms of this area and the action that could happen, if we take a volume profile over that area, look at this, 41.31 comes up. And it does, if you pull it realistically anywhere on this chart, very, very strong level. So somewhere between here and that 41.70 is going to be a very tough zone for the market to get through easily. The bears should be in hiding, trying to catch the salmon around this zone. Nothing is definite. You want to see, of course, some kind of market structure around there and always practice patience. Of course, you have to come up with your own concepts, but it's a good technical level and it would push things to an extreme that people won't like. So if that does happen, do we then see a new low and come back and test previous gaps that have been left behind down here and down and around here? It's certainly a very good strategy and very good concept because, of course, as we know, if we believe we're going into a US recession, the most correlated market conditions throughout history, which we like to use, have been those ones where we've seen double dips at the best case scenarios. The worst case scenarios, of course, pretty horrific times with well further drops to happen. At that point, we'll talk about where the markets could be going. So why is this week so important? Well, here's an easy chart to look at. Of course, we've got maximum pain up. Total open interest amount on the Friday just expired was 1.6 million. When we go out here to the 16th, take a look at this. It changes 4.75. So it's a huge increase. And this is only one side of the story. Across the board, there are options everywhere in this market this week. This is the one where we get the big data coming out that we'll talk about in a minute. Of course, inflation numbers, etc., etc. But realistically, the big options are here. So if you're a bear this week, you hope, you really do, that options calls are opened en masse. You want options calls everywhere over the next couple of weeks. In fact, you want the market to push up. You want millions of calls to go in, and that would be your best case scenario because at this stage, there's so many puts. Take a look at these put strikes, and they are everywhere at this stage. If we go down, you can see they're at 380, they're at 370, they're at 400, they're at 390. Every one of these 10-point blocks is pretty much significant to this market right now, and this options expiration will matter. So definitely subscribe to the channel because we'll be covering across that. What about Bitcoin? Well, it's at resistance right now. It's a kind of like a previous issue area that it had before. You've seen this a few times be a pretty key zone. So it could definitely drop off. I wouldn't be surprised to see it even possibly drop back into like a 20,000 and then maybe even rally back through. It's the weekend. Realistically, Bitcoin can do whatever it wants, but it came into a zone that I have been looking at for a little while, and I can see why the market at this stage has gone a little bit negative on this zone. So certainly Bitcoin right at that first area. Big second area is going to be around that 23,000 to 22,800 area. If we go over to the week ahead, what kind of big news do we have? Well, still a big amount of news. You know, it doesn't stop here in the markets. There's always something exciting to talk about. We've got CPI, core CPI inflation report, 8:30 a.m. New York time, Tuesday, September 13th. Then we have coming up the PPI number over on Wednesday, September the 14th, again at 8:30 a.m. New York time. And then we keep going through, and we've got even more annoying news, core retail sales and retail sales in general. Thursday, September 15th, 8:30 a.m. New York time, all 1 hour before these markets open. And then it keeps going into UOM prelim consumer sentiment, 10 a.m. New York time again. So it's a week of a lot of data. The market is data driven. As we know, the Fed is data driven. So expect fireworks, expect big moves, heavy volatility, and plenty of trapping. You've got to be careful out there this week. If you haven't already, come and follow us over at FX Evolution on Twitter. Join our Discord community, our public Discord community, over 10,000 members over there. And of course, if you're interested in our private Discord community, you can also click the links in the description down below. Another big announcement is just to let everybody know that's from Australia that signed up to the current sponsor of our channel, which is Tiger Brokers. If you did sign up during the month of August, you may have seen some delay, I believe, in the shares for the free zip share offer. Good news is that Tiger Brokers are actually giving you an extra 10 shares now, so to make up for that. So all of those delays were worth it because you're getting an extra bonus, and a big thank you to them for always really supporting the community and of course supporting the channel. Thanks so much, guys. If you enjoyed the video, make sure to subscribe, smash that like button, and we'll see you to normal resumption of our daily videos as of Wednesday next week, Australian time. So that will be the Tuesday after the close. Thanks so much for the support, and we'll see you very soon. Bye for now.